statistics you brought with.
Yeah, I mean, I do want to start off, though, by saying that, you know, it's really great to be in this room with all of you. I want you to understand that I consider this room to be San Diego's unfair competitive advantage in the venture business. And you may say, well, wait a second, all this stuff happens up in Silicon Valley and the like. The truth is that the fact that you can get your community together in a room has incredible positive, constructive effects that used to be the case back in the early 80s up in Silicon Valley. We've actually lost that productivity, and you have it down here, and I always love coming down to San Diego, and I do so very often, so it's really a pleasure to be here. I'm going to go through some slides that, being the chairman-elect of the NVCA, I have the benefit of being able to get the staff to put together the 2012 data so that you can see what's going on in the venture industry. And it'll sort of key us off for our discussion today about where's venture going from here. So we'll spend a little bit of time, you know, looking into the past. And I'll just give this one small blurb, but basically NVCA is a great organization that has proven itself time and again to be really effective representing both entrepreneurs and the venture community over really the past 40 years. The most recent accomplishment is the Jobs Act. That was started by a task force that was led by Kate Mitchell, who's a former chairman of NVCA, and literally it got swept up into a bipartisan coalition and passed. It's think sort of Dorothy's house in The Wizard of Oz being lifted by a tornado. And I'll tell you one small story about it to show you how dysfunctional Washington is. When it came time for the signing ceremony, many members of the NVCA were there in the Rose Garden to see the president sign it, but they had to delay the ceremony. And the reason was that the maintenance people at the White House could not find the signing desk because it had not been used in so long that they had to go find it to drag it out to sign this particular bill. So notwithstanding that dysfunctionality, NVCA is using every day, every hour to move policy efforts forward that will benefit entrepreneurs in the venture community. So talking a little bit about where we've been and that'll set the stage for where we're going. As you can see, the number of VC firms has peaked and in fact is in decline. This number, in our view at least, is probably going to settle out around 400 to 450. And we consider this a good thing. This is right-sizing venture capital so that we don't get out ahead of ourselves. The fundraising itself has slowed down. You can see what happened, the crazy year of 2000, but more recently, I believe that's about 21 billion, 22 billion this past year, and 27 billion were in the outflows. So if you put those two numbers together, you can see there still is a problem in venture. We're not bringing enough inflows in, and we've got more outflows for this past year. And the vast bulk of these amounts are going to existing fund managers. I think personally that the yellow is too small. We need to renew the industry all the time. I would like to see that at least twice the size of what it is, but that's what's going on most recently. And then in terms of numbers of companies, we're about right-sizing the numbers of companies that are being invested in. About 1,100 this past year, and that seems to be a good number that supports innovation and the like. But we got to dig down beneath that because there's some interesting data as we go into the sectors. So the number of fundings for life sciences companies is way down. It's down to 135 this past year. That's a very low number. You'll see it's the lowest number in the last 16 years. Clean tech, while the dollars invested have grown dramatically, the truth is that those numbers, if we had numbers of companies up there and we didn't have that data, is actually a lot lower. So as you see this, it's the, you can see the 12% number as a percentage of all the dollars invested, but this is mostly in follow-ons. And then IPO levels, that comes as no surprise to you, is far below what would be the correct numbers for a healthy industry. So we need to continue to drive that up. The Jobs Act is hopefully going to facilitate that, but in all frankness, it's going to take more than just that. The Jobs Act is a great on-ramping for IPOs, but there needs to be a freeway as well. And it's going to involve more market-oriented things like decimalization and other types of efforts to get the markets righted so that IPOs are a more attractive vehicle going forward. Acquisitions, you can see that they're improving. Having said that, a healthy IPO market is absolutely a necessity for creating a healthy M&A market. Without that counter and juxtaposition, neither one of these exits are going to be healthy. And then when we look at putting them both together, you can see that it's overwhelmingly still M&A. And that probably will be the case in terms of percentage relative to each other. But overall, again, the IPO market is a necessary counterbalance to make sure you can get the maximum amount on your M&A exits. So let's talk a little bit about San Diego, and David already talked about that a bit. It was up this past year, 4% of the overall national numbers, and in excess of $1 billion. Now this is an interesting chart because it does show you, how San Diego stacks up against the rest of the country. And again, David went over some of this as well. And so that sort of speaks for itself, I think. Interestingly, the New York metro area saw a huge increase this past year. This was mostly out of digital media companies, and we'll see. I mean, this is not life sciences. This is not clean technology and the like. So we'll see how that holds up in years going forward. When we take San Diego and split it into its various components, you can see that San Diego is heavily dependent on both life sciences as well as the clean technology. That's basically 70% of the total. And I think the lesson in that is that to the extent that San Diego can continue to create a robust IT environment, especially in the software area, I think that that would be it would be a very good thing for increased diversification. And finally, the pipeline is a bit thin. 16 companies this past year that were first funders within San Diego. That number needs to be a lot larger and the like. Now, the good news that isn't on these charts going forward is that it's at least my perception that JP Morgan conference, for those of you who are life science folks in the audience, JP Morgan conference was a tremendous blast out of the gates in a positive way this year. I know that one of my companies is going out for its follow-on round, and we've seen unprecedented interest in making the investment out of about a dozen different firms. A level of interest in life science investing that, frankly, I've not seen for at least 5 years. So this may say there's bad news, but I've got to tell you, at least the first month of this year, the first weeks, are showing much better news. So with that, I guess we'll go into the rest of the program.
Plug the annual meeting.